Every time price breaks the high of the day, two traders take opposite sides of the same candle. One buys the breakout, the other sells into it, knowing where it dies. The ICT Silver Bullet puts you on that second side. It combines a liquidity sweep, a market structure shift, and a fair value gap inside a narrow window of the London or New York session where volume makes a sweep mean something. Align the three, and you stop entering at random. The first move belongs to the crowd. Wait for price to break above the day's high during the London or New York session, and then quickly return inside the range, taking out the buy-side liquidity. That push attracts breakout traders. The fast return tells you their liquidity has been collected, and a reversal may be forming, especially during high-volume sessions. Understand what that candle really is. Those buyers act on recency bias. The last few times a broken high kept running. Their orders, plus the stops above, are the fuel a large position needs to get filled. The crowd reads strength. The other side reads inventory. Then comes confirmation, and it is not optional. A bearish market structure shift happens when price breaks and closes below the most recent swing low. That tells you buyers are losing control, and selling pressure is starting to dominate. Demand is no longer driving, and price can push lower with stronger momentum. This is where the trapped buyer becomes your counterparty. He still calls it a pullback because admitting the trade is wrong costs him more than watching it bleed. Now mark the bearish fair value gaps left by that displacement move and treat them as potential supply zones. These imbalances often act as retracement areas where institutions rebalance positions. Set a sell limit order at the beginning of the FVG zone and wait patiently for price to pull back into it. From there, price falls toward two targets. The first sits at 1-to-1, where you take partial profit and move your stop back to your entry price so the trade can no longer hurt you. The second sits at 1-to-2, where the rest of the position pays you for the patience. And watch what happens next. As price continues lower, a new fair value gap forms, and the same sequence repeats. Another imbalance, another sell limit at the beginning of the zone, another entry mapped in advance. Just always follow a disciplined risk management plan to protect your capital. Notice what the entry asks of you. Sell into a bounce. The move back into the gap feels like the reversal failed, and that discomfort is why the level is still unfilled when you arrive. Now, flip the chart, because the trap works just as well in reverse. Wait for price to sweep liquidity below the day's low during the London or New York session. A valid sweep forms when price breaks below a key level and immediately returns inside the range, signaling that sell-side liquidity has been taken. Next, wait for a bullish market structure shift to confirm that the reversal is valid. Finally, mark the fair value gap created during the displacement and plan your entry accordingly. If the fair value gap is relatively small, use a slightly wider stop loss to give the trade room to survive normal market fluctuations. From there, the same two targets. Even with the wider stop, the first entry pays 1-to-1 and then 1-to-2.5. The second entry runs 1-to-1, then 1-to-3.2, taking profit at the external buy-side liquidity. Same structure, opposite emotion. Here, the liquidity comes from the trader selling at the low, convinced the drop will never stop. The silver bullet is powerful for a reason that has nothing to do with indicators. It forces you to wait for liquidity to be taken, for confirmation to appear, and for imbalance to hand you the entry. Instead of chasing breakouts, you trade the reaction after they trap someone. And because the setup only lives inside a short session window, most of your day is spent waiting, the part almost nobody executes. Patience and risk management turn this into a structured, repeatable intraday model. So trader, please remember that the Com Lucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.